Hello and welcome back to the Microlearning Institute. In this tutorial we provide a comprehensive answer to the CPA Professional 2 Advanced Corporate Reporting Question 1 beta block from the April 2014 sitting. Let's start with Note 2 and we'll look at the goodwill in Staten. Now, beta block uses the full goodwill method for calculating goodwill. So that means that the structure of our working looks a little bit like on the screen right now. Firstly, we consider the cost of the group part of the acquisition, and in our case that was 400. And of course the share of the fair value of the net assets that were acquired for that 400 is 80% of the fair value of the net assets, which is made up of ordinary share capital of 150 and reserves at 225 at date of acquisition. So this share of fair value net assets is 300. So consequently there was goodwill recognized within the group at acquisition of 100. Of course, we use the full goodwill method to calculate goodwill, so for that we need to look at the fair value of the non-controlling interest at acquisition. And in the text we're told that the fair value of the non-controlling interest at acquisition was 79.5. And of course that's matched with 20% of the fair value of the net assets of Staten at 75. So the goodwill in the non-controlling interest at acquisition totaled 4.5. Therefore, there was a total goodwill of 104.5 recognized at acquisition. We're told that in the post-acquisition period, there's been an impairment of 8 million. And of course, the correct treatment for this is to split that impairment in the proportion of the ownerships between the group and the non-controlling interest. So you see, there we see the 80% of the impairment of 8 million, that is 6.4 million, allocated to the group, and the remaining 20% of the impairment of 8 million allocated to the non-controlling interest. So consequently, at year end, the 31st of the 12th, 2013, the goodwill in the group is impaired down to 93.6, and the goodwill in the non-controlling interest sits at 2.9. And of course, we have total goodwill to the consolidated balance sheet of 96.5. Staying with Note 2, let's now have a look at the goodwill in Maxlon. Okay, so again, Maxlon cost us 360. Again, the ordinary share capital and the reserves of Maxlon at acquisition were 300 and 390 respectively, meaning that the fair value of net assets of Maxlon at acquisition was 690. Now we, the group, acquired a 30% share, so therefore we have an associate relationship of this fair value net assets, whose value was 207. So consequently, the goodwill at acquisition of Maxlon was 153. We're also told a little bit about potential impairment in this associate Maxlon. So now we have to compare at what value we're carrying Maxlon at the date of the impairment and what the recoverable amount of Maxlon is at that date. So we're given some information about the recoverable amount of Maxlon on the 31st of December 20x3. Now at that time, we, the group, the beta block group, are carrying Maxlon at ordinary share capital and reserves of 300 and 450 respectively. And of course, when we look at Note 6, there's been an unrealized transfer profit which reduces the associates reserves by the difference between 35, which was the transfer price, and 25, which was the cost. So the carrying amount in the books of the group of Maxlon the associate at the 31st of the 12th, 2013 is 740. Now, we, the group, own 30% of that carrying amount. So we effectively are carrying Maxlon on the group accounts at 222. Now the recoverable amount, we also are not carrying it at cost, because of course you remember from the previous working that we didn't purchase it at its fair value of net assets. We paid a premium over and above the fair value of net assets. That premium is called goodwill, and if you look back at that working, you'll see there was a goodwill of 153 at acquisition of Maxlon. So therefore we, the group, are carrying Maxlon on our balance sheet at 375 at the 31st of December 2013. However, we're told that the recoverable amount of Maxlon in its entirety is 980. So therefore the recoverable amount of our 30% share of it is 294. So if we're carrying it at 375 and the recoverable amount is 294, IAS 36 impairment tells us that we must recognize an impairment of 81 in respect to the associate. Now let's move to Note 3, receivables. Okay, and again, Note 3, this is a financial asset because of course it is a contractual entitlement to receive cash. And IFRS 9 says that we can derecognize a financial asset only when the contractual risks have expired or the risks and rewards have been transferred. So therefore, in this case, we have not done this for the accounts receivable in Note 3, so consequently the accounts receivable that we've derecognized must be reinstated. And the transactions to do this are, firstly, we need to debit the accounts receivable for the full amount of 90 million. We need to credit the loan of 81 million. And of course, the balancing figure of 9 million will be a credit to our reserves. Let's next look at Note 4, revenue. So now we make the sale on the 1st of January 2013. And at that date, we get 20% of the actual selling price of 5 million. So that's 1 million. And we're also told that the remaining 80% will be paid after a period of time. And again, we have to discount that future payment by the finance charge at 6%, which is presented to us in Note 4. So therefore, the present value of the deferred consideration equates to 3.56 million. So the revenue that we would recognize on the 1st of January 2013 is the sum of 1 million plus 3.56 million, which is 4.56 million. Of course, we're interested in recognizing the revenue for the year, so we also must consider the unwinding of the discount to year end, the 31st of December 20x3. And of course, the discounted amount is 3.56, and we need to unwind a further 6% of that because 1 year has elapsed since we initially discounted the 5 million by 2 years. So therefore, the unwound discount component is 213.6. So therefore, the revenue that's recognized for year ended the 31st of December 20x3 is 4.7736 million. There is also, of course, some deferred revenue that needs to be recognized on the statement of financial position, and this is the remaining amount. So it's the 3.56 million plus the 213.6, and it's the remaining 6% that's recognized on the statement of financial position as deferred revenue. Next, we look at Note 5, which is a foreign exchange transaction. Okay, and we're told that we purchased a piece of equipment in dollars, and we paid 60% of the actual amount due of 20 million at the 1st of October 2013, when the exchange rate was 0.8. So at that stage, we recognized an amount on our statement of financial position of 9.6 million. Okay, and this 9.6 million is an asset because it relates to a refundable deposit. Now, at year end, we still owe the suppliers the 12 million, but in this case, the exchange rate has moved to 0.75. So now our asset, which is our refundable deposit, which was initially recognized at 9.6 million, is now recognized at 9 million. So consequently, we have a foreign exchange loss which must be charged to P&L of the difference between 9.6 million and 9 million, which is $0.6 million. Sorry, 0.6 million euros. Next up, we have the intercompany sales with Note 6, and again, this is the unrealized transfer profit with the associate that we spoke about earlier, and again, the treatment here is that we need to adjust the reserves of M. Note 7 tells us a little bit about a provision. Okay, so again, it's a single event, so consequently we must provide for the most likely outcome. And again, in the table of probabilities there, he tells us that the most likely outcome has a probability of 45%, and that's 32 million. Okay, now we need to debit profit and loss. So we already have a provision in the financial statements for 28 million. We need to increase that to 32 million, so we need to debit profit and loss with the difference of 4 million. And again, we need to credit the corresponding provision on the statement of financial position with the same 4 million. So this is the treatment of the provision on Note 7. Next up, we have a complex asset in Note 8. And we're told that we acquired a factory on the 1st of January 2013 for 60 million. Now we're told the factory had two components, one a building and one a roof. We're told that the roof had a cost of 5 million. So consequently, the remaining element of the 60 million, that is 55 million, must relate to the building. Of course, we now need to consider the depreciation charge. Now the roof has no residual value, and again its useful life is deemed to be 5 years. So the depreciation relative to the roof in any 1 year is $1 million. Now the residual value of 4 million then applies to the building, and the building has a useful economic life of 30 years. So therefore the depreciation that we recognize per annum in relation to the building is 1.7 million, and consequently the total depreciation that we need to recognize in a year is 2.7 million in relation to this complex asset using IAS 16. Note 9 tells us about borrowing costs. Okay, and again, the borrowing costs to fund this construction was taken from a general pool of borrowings. And when our borrowing costs relate to a general pool of borrowings, we need to calculate a weighted average capitalization rate. So when we look at all of the loans that we have on our balance sheet, we see we need to come up with a weighted average rate. So 2 million of our total of 5 million in loans have an interest rate of 6%, and 3 million of our 5 million have an interest rate of 4.5%. So consequently, the weighted average capitalization rate of our loans is 5.1%. So we can now, under IAS 23, or we must now, under IAS 23, capitalize relevant borrowing costs on qualifying assets at 5.1%. So let's look at what we capitalize. Firstly, we capitalize the actual cost of 4.5 million, but in addition to that, we capitalize the relevant borrowing costs in the period. And the relevant borrowing costs are the 4.5 million that we spent at the capitalization rate of 5.1%, and of course we time apportion it since the 1st of April by 8 months. So consequently we are capitalizing an additional 0.153 million, so the total amount capitalized is $4.653 million. Next up, we look at the debenture, and again the debenture is a financial asset, and it is carried at the using an amortization schedule. So the initial recognition for the debenture on the 1st of January 2012 is 1 million. In the year ended the 31st of December 2012, we recognize interest at the effective interest rate of 10% of 100k, and also a cash payment is received to offset that at 4%, which is the actual coupon rate of the debenture. So we receive a cash payment of 40k. So the outstanding carrying amount at year end is 1 million plus 100k less 40k, which is 1.06 million. In year end, the 31st of December 2013, again we recognize interest at the effective interest rate, now on the carrying amount of 1.06. So our interest is 106k, and once again we receive 40k to offset that. So at year end, 31st of December 2013, we have an asset of 1.126 million. Now we're told that at this time the recoverable amount is deemed to be, and again discounting the future payments in relation to the information received, the recoverable amount is deemed to be 0.859 million. Now our carrying amount was 1.26 million, so consequently we need to recognize an impairment to the profit and loss of the difference between the two of $0.266 million. Now that we've looked at all of the adjustments, we can now begin to do some work on the consolidated reserves. So the consolidated reserves, our structure for our working looks a little bit like this, where we start at the individual company reserves of each of the companies in the group, Beta, Staten and Maxlon, and we make the corresponding group and intercompany adjustments. So firstly, there's an operating lease. So note 1 there, he tells us at the end that we treat the lease as an operating lease. So an operating lease is recognized at the through the P&L at the amount of the annual payment. So this is 2.5. We also have a profit on sale there, which adds to our reserves of Beta by 2 million. There's the reversal of the financial asset, which we spoke about in this tutorial of 9. There's the revenue deferred, which of course is a liability of 0.226. There's the foreign exchange loss on the deposit, on the asset, of 0.6. There's the unrealized transfer profit. Now again, the unrealized transfer profit relates to transactions with Maxlon, which is the associate. So our rule of thumb in this instance is that we always adjust the reserves of Maxlon, and later you'll see that we will consolidate 30% of the reserves of Maxlon. So effectively, even though we've taken the full amount of the adjustments to the reserves of Maxlon, we'll consolidate 30% of those adjustments back into the group consolidated reserves. We need to recognize the provision, as we've looked at in this tutorial at 4. We need to recognize the depreciation on the complex asset at 2.7. Borrowing costs, again, are added to the carrying amount of the asset, and of course also go to reserves of 0.153. The development intangible, which he tells us about in the note, we need to eliminate the 5 million from there. And again, the impairment of the financial asset is an amount of 0.226. So therefore, our updated reserves for Beta, Statin and Maxlon come in at 801.861, 295 and 440 respectively. So this now is the updated reserves in compliance with fair value and adjusting for all of the other notes that maybe hadn't been adjusted for or had been incorrectly adjusted for throughout the question. So now that we've got the updated reserves, we can now consolidate these reserves. Now 100% of Beta Block's reserves will be consolidated, plus the group share in Statin, the group share post-acquisition in Statin. So Statin's post-acquisition reserves from the previous working are 295, and if we look at acquisition, they were 225, and 80% is the group share. So we consolidate 56 of the group share in Statin, and also 30% of the movement in the reserves of Maxlon. And of course the updated reserves are now 440, whereas the reserves of Maxlon at acquisition were 390, so we consolidate 15 from Maxlon. Now we need to deduct from this the group goodwill impairment. So the group share of the goodwill impairment in Statin, when the group share of the goodwill impairment there was 6.4, if you remember, 80% of the 8 million impairment, and the full amount of the goodwill impairment in Maxlon. So that gives us a deduction in relation to goodwill impairment of 87.4, resulting in consolidated reserves of 785.46. Next up, we can now look at non-controlling interest. And again, in order to establish the non-controlling interest, we need to look at the fair value of the net assets of Statin on the 31st of the 12th, 20x3. And of course they comprised ordinary share capital, which is 150, and the fair value of the reserves, which of course is the update value of the reserves of Statin from our updated reserves working. And that meant that the fair value of the net assets of Statin came in at 445. The non-controlling interest owned 20% of those, because we, the group, owned 80, the non-controlling interest owned 20%. And of course, if we go back to our goodwill working, we see that there still remains 2.9 million in goodwill attached to the non-controlling interest. So therefore, the carrying amount of the non-controlling interest at the 31st of December 20x3 is the sum of 89 plus 2.9, which is 91.9. Alternatively, we could have done the same working, we could have done this working in an alternative way, where we looked at the fair value of non-controlling interest at acquisition, added the share of the post-acquisition profits, and deducted the share of the goodwill impairment, again resulting in the same result of 91.9. So there are alternative treatments for non-controlling interest. Next up, we look at the investment in the associate, and again we need to look at the fair value of the net assets of Maxlon on the 31st of December 20x3. Again, that's made up of the ordinary share capital and the fair value of reserves from our updated reserves working. So that's 300 and 440, which totals 740. We have a 30% share. We, the group, have a 30% share, which equates to 222. But of course, again, we have goodwill, and of course the initially recognized goodwill of 153 has been impaired by 81, so the amount of goodwill that's now attached to the associate is 72. So at year end, 31st of the 12th, 2013, the investment in associate line item on our statement of financial position is 294. Similarly, we could also have then done this working in an alternative way, where we look at the cost of the associate, we look at the share of their post-acquisition profit, and we deduct any impairment, again giving us 294. So now, finally, we have all the adjustments that we need in order to prepare the consolidated statement of financial position. Firstly, let's look at property, plant and equipment. So again, we have property, plant and equipment of 3,400 and 300 respectively in the two group companies. However, we need to deduct the leased asset that he tells us about in note 1. We need to capitalize the borrowing costs, and we need to depreciate the property, plant and equipment of the complex assets. So our consolidated property, plant and equipment is 3687.5. Goodwill directly from our working is 96.5. The intangible stays at 600. The associate directly from our working is 294. The financial asset, if you remember, was impaired by 0.226 to 0.774. The inventory in the individual company accounts of 1,600 and 150 needs to be adjusted for the note in the question regarding development inventory. So our consolidated inventory is 1,745. Accounts receivable in the individual companies is adjusted for a foreign exchange loss in the deposit for deferred considerations with regard to revenue and the reinstatement of the financial asset or the accounts receivable. So our consolidated accounts receivable comes in at 1379.17. Cash, again we have a lease payment for the operating lease in terms of cash, and we also have receipts in terms of the sale of that leased asset as such prior to the lease back. So the cash consolidates at 1069.5, giving us a total asset side of the balance sheet at 8872.4. On the other side of the balance sheet, we have ordinary share capital of 3,000 in relation to the holding company, Beta Block. We have reserves, again directly from the working, of 785.46. We have other components of equity, again directly from the accounts of Beta Block, of 600. We have non-controlling interests, again directly from the working, at 92. We have current liabilities, so again the current liabilities in the individual companies are adjusted for the provision and the reinstatement of the loan at 81. And we have non-current liabilities which sit at 1,400. So therefore our total equity and liabilities side of the balance sheet totals 8872.4. Thank you very much for watching this short tutorial in relation to Beta Block from the CPA Professional 2 Advanced Corporate Reporting paper from April 2014.